Have you ever wished you could just get an X-ray of a company's financial bones? See its true health in a single glance? Well, you actually can. It's called the balance sheet, and that's exactly what we're going to break down today.
So let's just jump right in. How do you really see what's going on inside a company, past all the fancy marketing and the big headlines? Well, you look at its financial skeleton. And the balance sheet, that's our snapshot. It gives us a crystal clear picture of what a company owns and what it owes at one specific moment in time.
And the best part? The entire thing is built on this one beautiful, simple equation. Assets equal liabilities plus equity. It's that straightforward. Everything a company owns, that's its assets, has to be paid for by either borrowing money, which is a liability, or by using the owner's money, which is equity. It always, and I mean always, has to balance.
So here's our game plan. We're going to run a 5-point health check. We'll start by checking the company's pulse. Then we'll assess its long-term strength. After that, we'll figure out what the owners truly get to keep. And finally, we'll talk about what a healthy financial diet really looks like.
Okay, first up, let's check the most immediate vital sign, the company's pulse. This is all about its short-term health, what we call liquidity. The big question is, can this company pay its bills tomorrow? Next week? Next month? Let's find out.
And to measure that pulse, we look at something called working capital. Seriously, think of it as the financial lifeblood that keeps the day-to-day operations going. We figure it out by taking all the assets that can be turned into cash within a year, that's current assets, and then we subtract all the bills that are due within that same year, those are the current liabilities. A positive number? That's great. It means you've got a cushion. A negative number? Well, that's a red flag.
But, working capital is just one number. To get a really accurate reading, we need the financial equivalent of a doctor's tools. And in finance, we call these liquidity ratios.
And for our purposes, we're going to focus on two main tests. First, you've got the current ratio, which is kind of like a general checkup. And then you have the quick ratio. Think of that one as a much tougher stress test.
Now here's what's so important to understand. The current ratio looks at all the current assets, but the quick ratio, it's a bit more skeptical. It asks the tough question, yeah, but what if you can't sell your inventory? So it totally excludes inventory and focuses only on the stuff that's super easy to turn into cash, like, actual cash and money that customers already owe you.
And this right here, this is what we call the inventory trap. It's a classic. A company could have a warehouse just packed with last year's gadgets. On paper, their current ratio looks fantastic because all that inventory is counted as an asset. But in reality, they can't turn it into cash to save their lives. The quick ratio just cuts right through that illusion and gives you a much harsher and, frankly, a much more accurate picture of their health.
Okay, so we've checked the daily pulse. Now let's zoom out and look at the body's core strength. This is all about solvency, a company's ability to survive for the long haul and handle the real weight of its debt.
And this is where we get into the really big stuff. We're talking major loans and bonds that paid for new factories, big tech upgrades, and major growth projects. These are the heavy-duty obligations that aren't due for at least another year.
Now here's the critical connection you have to understand. A long-term problem can become a short-term emergency in the blink of an eye. A company's solvency and its liquidity are way more connected than you might think.
So picture this. A company has a 10-year loan, right? But that loan has certain conditions or covenants, like say they have to maintain a certain level of profit. Well, what happens if they miss that target? They've just breached the covenant, and the bank can turn around and demand the entire loan be repaid immediately. Just like that, a long-term problem is now a massive short-term crisis, and the company is scrambling for cash overnight. It happens.
All right, so we've covered what a company owes. Let's get to the good part. What does it truly own? This brings us to the final piece of our puzzle, shareholders' equity.
Equity is, quite simply, what's left over for the owners after every single bill, short-term, long-term, all of it has been paid off. It's the company's net worth, it's the bottom line for the people who own the place.
And when you look at a chart like this, you instantly get a feel for the company's capital structure. You can see exactly how the business is financed. It's all there in the slices of the pie. How much comes from short-term debt, how much from long-term debt, and how much is from the owner's own funds.
And this visual really highlights a huge strategic choice every company makes. Using debt is often cheaper because the interest you pay is tax-deductible, but it's risky. If you can't make your payments, you could go bankrupt. Using equity, on the other hand, is safer since you don't have to pay it back, but it's more expensive, and it means the original owners have a smaller piece of the pie. It's a constant trade-off. You know, if you dig into the equity section, it really tells a story. Contributed capital, that's the cash shareholders put in at the beginning. Retained earnings shows all the profit the company has kept and plowed back into the business over the years. It's a huge sign of past success and a strategy for future growth. And treasury stock is really interesting. That means the company is buying back its own shares, which is often a powerful signal that management thinks their stock is a bargain.
Okay, we've looked at the X-ray, we've checked the vital signs. I think it's time to put it all together and come up with a final diagnosis. So what does a healthy financial diet actually look like?
So here's a little practical toolkit for you. For those key liquidity ratios we talked about, here are some typical benchmarks for a healthy company. You generally want to see a current ratio above 1.5, and a quick ratio somewhere between 1.0 and 1.5 is pretty solid. It suggests a company can meet its immediate bills without having to sell a single piece of inventory.
But, the ultimate goal isn't just about having the highest ratios. It's about finding a smart, strategic balance. A healthy company has enough cash to operate smoothly and enough long-term stability to be solvent, but it's not so conservative that it's just sitting on mountains of cash that isn't doing anything. It's all a delicate, strategic dance.
Which brings us to a final question for you to think about. If a company's balance sheet really is its annual health report, what kind of financial lifestyle choice, like being addicted to debt or maybe hoarding way too much cash, what would make you want to invest? Or maybe run for the hills?